Hi, I'm Danielle Hale, Chief Economist for Realtor.com, and here are this week's Things You Need to Know. The National Bureau of Economic Research determined that the U.S. economy officially peaked and is now in a recession. This gives us a common term to use to describe conditions, but the declaration itself doesn't really change what's already going on. The Fed met and left short-term rates unchanged, but there are two things to note from the meeting. First, the Fed released updated economic projections that show a steep decline in economic activity is forecast in 2020, and most on the Fed expect near zero interest rates to be appropriate through the entire forecast period, which currently stretches through 2022. Second, the Fed promised to continue buying Treasury and mortgage-backed securities to sustain smooth market functioning. Both of these points should pave the way for low mortgage rates ahead, and in fact, this week's mortgage rates remained near record lows. In the jobs market, signs of progress, but still elevated stress. Another 1.5 million workers filed unemployment claims, bringing the 12-week total to more than 44 million. Turning to housing data, the Realtor.com team looked at what high unemployment might mean for young, future homebuyers who may have to dip into their down payment savings to make ends meet right now. The typical U.S. millennial will have to save another 9 months to recoup just 1 month's worth of expenses. Of course, expanded unemployment benefits should offset some of these expenses, but the longer unemployment remains high, the more likely we are to see individuals raiding savings and delaying a home purchase. Despite job market weakness, homebuyer demand is strong, according to our new Housing Market Recovery Index. This weekly indicator tracks how the housing market is performing now relative to its trend early in the year, in the U.S. and 50 large metros. The Housing Market Recovery Index distills indicators on demand, supply, and market balance into a single summary statistic. The higher the index, the better an area's housing recovery, and vice versa. The Recovery Index shows that while demand and prices are fully recovered nationwide, supply and the pace of sales still have room to improve. But for the first time post-COVID, all of the component indicators are improving. For details and to get the data, visit Realtor.com/research or follow us on Twitter. The housing market has displayed incredible resilience in the face of uncertainties generated by COVID, an economic recession, and civil unrest. But there's still more ground to make up. We'll continue to track it and keep you up to date. Have a question about the economy or housing markets? Ask away.